Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. If you've lost all your money invested in Nikola this year, I have good news for you. Losing all your money in a crazy speculation YOLO play can help you offset some of the gains you may have got and lower your tax bill for the year. This is called tax loss harvesting. And you know, the IRS does want to tax you for all the money you've made, but they also help you recognize your losses too. But there are rules and limits on how much losses you can recognize on your tax bill. And at the end of this video, you're going to know enough about tax loss harvesting from some guy on the internet that you can go and ask a real professional in real life on if it's right for you. Because, quick disclaimer, I'm just some guy on the internet, and you need to talk to your own professional guys about taxes and all this kind of stuff to see if it's like right for you. Because I could be wrong. This is stuff I read on Investopedia and other videos about tax loss harvesting. So if you're new to the channel, I'm Justin. I like to talk about dividend investing, income from options, financial independence, putting out about 3 videos a week. So really appreciate it. You give me a little thumbs up in this video and subscribe to the channel if you haven't, all right? So first off, all this tax harvesting stuff, it only applies to your individual brokerage type accounts. Does not apply to your 401k, your Roth IRAs, your traditional IRAs, or any tax sheltered account like that. It's only individual, brokerage accounts. Now, the IRS is going to want to tax you on your gains, but only when you sell a stock. So if you imagine you invest, your $10,000 into a company, and then it goes up in price, and you sell it, and you make $1,000 off of that position, you're up $1,000. The IRS is going to want to tax you on that $1,000. Now, depending on how long you've held the position in your individual tax account or your individual tax bracket, that amount of tax will differ, but we're not going to get into tax rates right now. We're just going to talk about this tax loss harvesting stuff. So the IRS will tax you on that $1,000. Now imagine if we have 2 positions, we sell the one position and we make $1,000 off of it, and we have position B, and on this one we lose $500. This one was a loser, and we're down $500 on this position. Now we can take the losses from position B and count them towards position A. So our $1,000 taxable gain now is only $500 because we can subtract the losses from position B. Now the tax loss harvesting part is when people intentionally or strategically sell losing positions. And it's often thought about or mentioned in December because it's the end of the tax year. And at the end of the tax year, you can check your portfolio, you can rebalance, sell off losing positions to create that taxable event of when you sell a stock and lock in those losses that you can count against your gains. But it's important to know that there's no tax harvest season. Your losses for the entire year can count towards your tax bill. So there's nothing special about, selling off in December for the end of the tax year. Another cool thing is maybe you only have losses in your investment portfolio. Those losses in your investment portfolio can still count against your ordinary income and reduce your ordinary income tax bill. But there's a limit to how much you can do on this. And the limit, you can only claim $3,000 a year in losses. If you make $5,000 in gains in one position, but then you lose $9,000 in another position in the same year, you can only claim $3,000 a year, so that your 5,000 gains can go down, can reduce to $2,000. You only have to pay taxes on that $2,000, but now you still have $6,000 in losses, and you can use $3,000 of that next year, and then the rest of the $3,000 in the year after that. Now, you might be thinking, why don't I just sell a position when it's down and collect the tax loss harvesting and then buy back in my position? Well, the IRS has a thing called the wash rule, and they're not going to let you do that. And the wash rule says that you cannot buy a substantially identical security or position within 30 days of selling your original one. An example of that would be, you cannot sell SPY and then buy VOO. Both of those are S&P 500 indexes, and they're pretty much the same thing. They just owned and ran by different people. So you can't do that, or you don't get to use the tax loss to write off your losses. And substantially identical is a little wish-washy, so you might need to just use common sense with this. Another example is what you could do is you could if you sell Google or Facebook, then you could buy a sector ETF, VLK or the Qs, or some sort of tech sector based ETF if you sell off like a tech company. Another thing you do is you could sell AT&T and buy into Verizon. Both are cell phone companies, but they're different companies, so you could do that. And you probably couldn't do something like sell SPY and then buy a leap call option on SPY. You probably couldn't do an ETF to an option or something like that. But you need to use some common sense when substantially identical. Now, violating the wash rule isn't illegal, and you're not going to get fined or anything for that. You just won't be able to write off those losses towards gains for the year. And you probably shouldn't make tax loss harvesting some sort of deciding factor in your investing. Just if you are holding something for a long time, for years, it's not, you probably shouldn't just sell it at the end of the year and buy it back a month later, even if your time frame is years. That's just, it's not really a thing that should be a deciding factor. If the circumstances fit, then maybe, go ahead and, sell this thing off so you have that loss that you can count against your gains. But don't let it be, just be like, what do I have to sell this year? Or, or do something weird where you intentionally take a loss so you can sell that and then count that towards your gains, because that won't make any sense at all. And you don't have to do it in December either. We had the big sell-off in March this year, so a whole bunch of us should have some sort of losses that we can count towards our gains. So we don't have to worry about anything in December. We probably don't have anything to worry about in December, because a lot of us did take some losses in the big correction in March and April. So there's a little bit about tax loss harvesting. Remember, I'm just some guy on the internet, and you need to do your own research on this stuff and look at your own portfolio, and then maybe talk to a tax professional, see if it fits your personal circumstances. Go ahead and give me a little thumbs up. I'd really appreciate that. Subscribe to the channel if you haven't. Trying to put out videos 3 times a week. And then I'll put some other videos over here that we can watch. And I want you to go have a good day, all right? Justin out.